Welcome to our all-new online Forex trading course. The following videos will introduce you to the largest, most lucrative market in the world and will prepare you for an exciting career as a Forex trader. Every one of our quick and easy-to-follow lessons will add a new concept, each building on the last in a highly intuitive and accessible way. By the time you have made it through the course, you will be armed with everything you need to know in order to start trading. You will also be able to further your education by accessing one of our more advanced courses. So, if you're ready to learn how to trade Forex, let's begin. Online trading is one of the internet's biggest success stories. The revolution in personal computing, followed by the widespread availability of internet access, has opened up markets that used to be the exclusive domain of large financial institutions. As a result, it's now cheaper and easier to trade than ever before. As a beginner, it's important to recognize that you can now take control of your financial destiny in ways that were impossible only a few decades ago. Information is the driver of this process, and you're lucky enough to have access to more of it than any other generation before you. Learning to tell the difference between the information that's valuable to you and that which isn't will be your main focus as a trader. It's also what this course was designed to prepare you for. There are many advantages to trading Forex, other than its affordability and accessibility. Forex is a completely decentralized global marketplace that is open 24 hours per day, 5 days a week. It's also the largest and most liquid market in the world, with a turnover of over $5 trillion per day. The sheer size of this market and its necessity in all areas of human life also makes it incredibly difficult to manipulate. If you think about it, there's a foreign exchange component to every single transaction that takes place in the global economy, whether it's nations trading with each other, corporations, or individuals like yourself purchasing items online. In fact, even trading in other instruments like stocks, indices, and commodities also requires foreign exchange. For this reason, Forex is the king of all markets, the market that all others depend on in order to be able to function. Currency pairs are probably the easiest trading instrument to understand for beginners. This is because we're all familiar with using our national currency and exchanging it for different ones when traveling abroad. All currencies are quoted in pairs, with each being represented by a 3-letter code. For instance, EUR/USD represents the Euro-US dollar exchange rate. The first currency in the pair is known as the base currency, in this case, the euro. The second currency in the pair is known as the quote or counter currency, in this case, the US dollar. The figure that you see quoted tells you how much of the quote currency you need to spend in order to buy 1 unit of the base currency. So, if the EUR/USD exchange rate is currently at 1.05, this means that 1 euro is currently worth $1.05. When trading Forex, you will be quoted 2 prices for any currency pair that you want to trade. The bid price is the highest price that buyers are willing to pay for the currency in question. The ask price is the lowest price that sellers are willing to accept in order to sell that same currency. The difference in price between these two figures is called the spread. More on this later. To put it simply, when buying, you receive the ask price, and when selling, you receive the bid price. The terms bid and ask can sometimes be confusing, even for intermediate traders. But a nice trick to help you remember which is which is to keep in mind that as a buyer, you pay the price that the market is asking for. The word pip stands for percentage in point. In Forex trading, it's used to refer to the smallest unit of change that a currency pair's price can undergo. With the exception of the Japanese yen, which has been historically quoted to the 2nd decimal place, the pip is always the 4th decimal place of a currency pair, or 1/10,000th of that currency's value. For increased accuracy, most modern brokerages now quote the majority of their currencies to 5 decimal places, and the yen to 3. This extra decimal point is often referred to as a precision point, with the pip still keeping its place as the 4th decimal place on most currencies. Pips are important for calculating how much a currency pair's fluctuating price is worth to your trading account balance. Here is an example of a pip calculation on EUR USD. Take the amount of euros you are buying or selling, which is also known as the volume or lot size. Again, more on this later. And multiply it by 1 pip. For this example, we will be trading 10,000 units. 10,000 times 0.0001 equals 1. If your trading account is denominated in US dollars, then this tells you that every move of 1 pip in the EUR USD exchange rate is worth $1 of profit or loss to you. If your trading account is denominated in another currency, you simply convert that $1 into your own account currency in order to know exactly what each pip is worth to you. The spread, also known as the bid-ask spread, is the difference between bid and ask prices that are available to you on any given currency pair. For instance, if the platform you're trading on is quoting the bid price for EUR USD at 1.0510 and the ask price at 1.0511, this means that there's a 1 pip difference, or spread, between the bid and ask prices. It also means that if you bought at the current ask price, you would need the EUR USD exchange rate to rise by 1 pip in order to break even. In highly liquid markets like Forex, spreads, especially those on the major currency pairs, tend to remain low. This is another benefit of trading Forex. However, you can expect spreads to increase at highly volatile times or when there is not much buying and selling going on. One of the great advantages of Forex trading is that it's easy to take advantage of both rising and falling markets. This is because bidirectionality is built into the very structure of the Forex market. A currency pair's price isn't just an arbitrary number. It tells you all about the current relationship between two currencies. So, for example, in the case of the EUR USD pair, a rising exchange rate not only means that the euro is strengthening, but that the US dollar is simultaneously weakening. This is because as the euro rises in value, it costs more US dollars to purchase euros. For this reason, Forex traders will go long or buy when expecting a rise in the base currency, and they will go short or sell when expecting a drop in the base currency they are trading. In trading, leverage is basically a type of interest-free loan that allows you to multiply the value of your investment. Leverage is expressed as a ratio. So, if you have $1,000 in your trading account and are using a 1 to 100 leverage, you're able to command a position that is worth $100,000. Forex traders are fortunate to have some of the highest leverage ratios in online trading available to them, but you should always be aware of the risks. While leverage can multiply your gains when a trade is going your way, it can also multiply your losses when a trade suddenly turns against you. For this reason, it's important that you use leverage wisely and in conjunction with sound money management rules. Margin essentially works like a security deposit. Every trade you want to place will feature a margin requirement. This tells you what percentage of the value of your trade is required by your broker up front in order to guarantee your trade. So, if you're trading EUR USD and your broker's margin requirement for this pair is 1%, then in order to trade 10,000 euros, only 100 euros of your account balance must be secured as margin. If you think about it, margin and leverage are basically the same thing expressed different ways. So, the 1% margin requirement in our current example is the same as saying that the broker's maximum leverage on EUR USD is 1 to 100. An easy way to convert between margin and leverage is to use the following formula. Margin equals 1 divided by leverage. Now, let's take a closer look at your trading platform. The MT4 platform offers professional and feature-rich market access to traders of all levels. The platform consists of 4 distinct areas: Market Watch, Navigation, Charts, and Terminal. At the top of the screen, you'll find the main menu, which allows you to access the wide range of features and options offered by the platform. You can log into your account, open trades, and access charts and indicators, all from the navigation menu. To the left of the screen, the Market Watch sidebar provides the latest price information on the dozens of available currency pairs. It displays the name of a pair and the latest bid-ask prices for each one. At the bottom of the platform, you'll find a series of tabs that you can use to keep track of all your latest activity. These include current trades, account history, alerts, messages, and journal. In the center of the screen, you'll find your chart area, which is where you will be monitoring the performance of your chosen currency pairs from. The chart also allows you to monitor your pairs at different time frames and will display whatever technical indicators you choose to apply to them. To view a new chart for any currency, simply right-click on the desired pair in the Market Watch sidebar and select Chart Window. This will bring up a new chart. To maximize a chart, click on the Maximize icon on the top right of the chart window. To switch between charts, use the tabs at the bottom of the chart area. The chart window allows you to monitor multiple currency pairs at the same time, which is particularly useful if you are actively trading more than one currency pair at the same time. To open a new pair, click directly on the pair which you'd like to trade, either from the Market Watch sidebar or from an open chart. Next, choose the volume that you want to trade. In Forex trading, the amount or volume of the base currency you're purchasing is described in lots. One lot equals 100,000 units. One mini lot equals 10,000 units. One micro lot equals 1,000 units. Next, choose to either buy or sell the currency pair in question. You will receive a confirmation message as soon as your trade has been executed. In order to close a trade, first locate it in the Trade tab beneath the Terminal window at the bottom of the platform. Right-click on the order to be presented with the option to close it. Alternatively, you can double-click on the order to bring up the Order window. From here, you have several more options, as well as the ability to close it. There are two basic order types: market orders and pending orders. Market orders are the easiest to understand. They are simply an instruction to buy or sell at the best price currently available in the market. There are four types of pending orders, each allowing a trade to automatically be placed on your behalf when certain price criteria are met. Buy limit, sell limit, buy stop, sell stop. Buy limit orders allow you to automatically buy a pair at a price that is better or lower than the current price. You simply specify your chosen price, and it will only be triggered if the price drops to this level. Sell limit orders do the same thing for sell orders. They allow you to sell at a price that is better or higher than the current price. You simply specify a chosen price that is higher than the current market price. The order is only triggered if the market moves up to this level. Stop orders are similar to the limit orders previously described. However, whereas limit orders allow you to take advantage of a better price, stop orders secure a slightly worse price for you in case the market you are trading starts to move in the opposite direction. So, in the case of a buy-stop order, if you are worried that the price may rise and you don't want to lose a good trading opportunity, you can ensure that a buy order is automatically placed when the current price rises to a certain level. Sell stop orders essentially do the same thing in reverse. So, if you're not sure about selling at the current price, but want to avoid the risk of the market falling, you can ensure that a sell order is automatically placed when the current price falls to a certain level. Technical analysis is a type of market analysis that is primarily concerned with historical prices. Technical analysts, or chartists, as they're also known, are not interested in what's going on in the broader economy or about a currency's intrinsic value. All they care about is what is actually taking place on the chart. Technical analysts employ various mathematical methods, also known as technical indicators, to study the information available to them on each chart. This information is basically the opening price, closing price, high point, and low point that took place within a given period of time. In this way, they attempt to identify overbought and oversold conditions, which allow them to predict where the price is most likely to go next. From the perspective of technical analysis, all the important information about a currency pair has already been priced in, and markets are thought to react similarly in similar situations. Support and resistance are the easiest kind of technical analysis tools for beginners to understand. This is because they require no complex mathematical studies. Support is essentially a level that the price of a currency pair is finding it difficult to trade below. Resistance is a level that the price is finding it difficult to trade above. For example, in 2016, EUR-USD repeatedly traded around the 1.14 mark, but failed to break above it for any prolonged period of time. In other words, 1.14 was an important resistance level for this currency pair in 2016. To plot resistance levels, you simply identify a high point that your chosen pair keeps reaching without being able to break above it. You then draw a line connecting every instance in which this level was reached. This line now provides you with a useful sell signal. For support lines, you do the opposite, connecting every instance of prominent low points in order to give you a useful buy signal. Fundamental analysis is in many ways the opposite of technical analysis. While technical analysts only look at the internal factors of price action, fundamental analysts are mostly interested in the external factors that determine a currency pair's value. Fundamental analysts believe that currencies are either over or undervalued and that they are always moving towards some state of equilibrium. A Forex trader performing fundamental analysis will focus on what is going on in the relevant country's economy. For instance, its GDP, how its industries are performing, its unemployment levels, the demand for products and services as defined by the spending of its consumers, and much more. The aim of such analysis is ultimately to determine whether the current exchange rate for a given currency is undervalued or overvalued when taking the new available data into account. Economic reports are highly important to fundamental traders as they reveal a great deal about the health of economies and their currencies. For instance, interest rate announcements are among the most important economic data because higher interest rates attract foreign investment and generally cause currency values to rise. Industrial production figures are also very important as they indicate how much demand an economy is experiencing for the products that it produces. Similarly, unemployment figures are also closely monitored because they provide signs that an economy is either expanding or contracting. The same is true of retail sales figures, which say a great deal about how prosperous an economy's consumers are feeling. These reports can be looked up by using an economic calendar to find out when the most important data from the countries you are most interested in are due to be released. Now, let's look at a trade example that will bring together some of the concepts you've already learned. You've been monitoring the EUR-USD exchange rate and have identified 1.04 as a solid support level. Despite the euro's recent decline, you decide that now would be a good time to buy. Your broker is currently offering an ask price of 1.05255 and a bid price of 1.05242, making the current spread 1.3 pips. You decide to purchase, or go long, on one mini lot of EUR-USD. Your broker's margin requirement on this trade is 1%, meaning that the maximum leverage available to you is 1 to 100, or that $100 of your trading account balance will have to be posted as margin for this trade. It also means that a 1% drop in the EUR-USD exchange rate will cause you to lose your trade margin and your trade will be closed. On the other hand, a 1% rise will earn you $100. You press buy and have successfully made your first Forex trade. Congratulations! You have made it to the end of our introductory Forex trading course. You should now have a solid understanding of all the fundamental concepts of Forex trading. We recommend that you go over the course a few times, just to cement your knowledge, and return to it whenever you feel the need to refresh your knowledge. Our recommended next step is to try and apply some of what you have learned by trading on your broker's free demo account. This will help you put this knowledge into practice without risking any of your own money. Once you have done this, you will be ready to begin your career as a Forex trader. Thank you for watching, and we hope that you enjoyed the course.